Interest is one of the most fundamental and ubiquitous concepts in the realm of finance. It represents the cost of borrowing money or the reward for investing it. Understanding interest is essential for both individuals and businesses as it influences a wide range of financial decisions, from choosing a mortgage to evaluating investments. This text delves into what interest is, its types, its impact on the economy, and its role in personal and corporate financial decisions. Concept of interest can be defined as the cost of money over time. It is the amount a borrower pays to a lender for the use of money over a specific period. In other words, it is the price of borrowed money or the return on invested money. It is generally expressed as a percentage of the principal amount, known as the interest rate. Types of interest. Simple interest. This type of interest is calculated only on the original principal amount, without taking into account any accumulated interest from previous periods. Simple interest is straightforward and easy to calculate, making it a common choice for short-term loans and investments. Compound interest. Unlike simple interest, compound interest is calculated on the principal amount and also on the interest accumulated from previous periods. This means that the interest earned each period is added to the principal, and in the next period, interest is calculated on this new sum. Compound interest is more common in long-term investments than loans, as it can significantly increase the total amount over time. Importance of interest. Interest plays a crucial role in the global economy. It affects everyone, from individuals to governments, and influences a wide range of financial decisions. For individuals, interest affects saving and investment decisions. Higher interest rates on savings accounts can incentivize individuals to save more. Conversely, high interest rates on loans can discourage people from borrowing for major purchases like homes or cars. For businesses, interest rates influence investment and financing decisions. Companies are more likely to invest in expansion projects when interest rates are low because the cost of financing is lower. Conversely, high interest rates can reduce business investment. For the economy, central banks, such as the Federal Reserve in the United States or the European Central Bank, use interest rates as a tool to control inflation and stabilize the economy. By adjusting interest rates, they can influence the level of spending and investment in the economy. Factors influencing interest rates. Interest rates are not fixed and can vary due to a variety of factors, including monetary policy. Central banks set interest rates to control the money supply and inflation. For example, they may lower interest rates to stimulate the economy during a recession. Inflation. Expectations of inflation affect interest rates. If inflation is expected to rise, lenders will demand higher interest rates to compensate for the loss of purchasing power of the money lent. Credit risk. The risk that a borrower will default on their debt also influences the interest rate. Borrowers with higher default risk generally have to pay higher interest rates. Supply and demand for credit. The demand for loans and the supply of funds available for lending also affect interest rates. Excess demand for credit can lead to higher interest rates, while a high supply of funds can lower them. Impact of interest on financial decisions. Understanding interest is essential for making informed financial decisions. Here are some examples of how interest affects various areas. Loans and credit. Interest rates affect the total cost of loans. For example, in a mortgage, a small difference in the interest rate can mean thousands of dollars difference in the total payment over the life of the loan. Investments. Interest rates affect the returns on investments. Bonds, for instance, have yields that depend on market interest rates. When interest rates rise, the prices of existing bonds typically fall and vice versa. Savings accounts and certificates of deposit, CDs, pay interest on deposited money. Higher interest rates can incentivize people to save more as they get a higher return on their money. Retirement plans. Interest rates also affect retirement plans and pensions. Low interest rates can make it harder for pension funds to generate the necessary returns to meet their future obligations. Interest is a powerful tool in the financial world, influencing everything from personal decisions to national economic policies. Understanding how interest works is crucial for effectively managing money, whether for saving, investing, or borrowing. changes in interest rates can have wide-ranging implications, affecting not only individuals and businesses, but also the economy as a whole. Therefore, staying informed about how interest works and current trends in interest rates can help make more strategic and informed financial decisions.